Okay, welcome to episode 9 on the put path. This is the last episode in our introductory module that's showing you the methodology on how to trade the put path options trading system. So, most important thing I think in the whole system is how to close out your trades. This is the discipline that determines if you make money or not. So, I want to walk you through it step by step, making sure that you understand when to close, how to close, and keep you profitable. So let's dive right in. So you've started, you're working your way down the steps of the put path. The last step, unfortunately, in many cases, is buying these back for a debit at a loss. Other times, you're still going to buy them back, but you're going to buy them back for a small debit, which is effectively 100% winner. So let's walk through the methodology and the logic behind this. If you know anything about the stock market, basically you've heard buy low, sell high. That's exactly what we're doing with these put credit spreads, except kind of in reverse. So in our case, it's a slight variation. What we want to do is close low at the end. We open high at the beginning. So what do I mean by that? That's really the same thing as buy low, sell high. We're just doing it in reverse because when you're opening the spread, your profit driver is selling the put position. So you're selling short. You sell first, which is unusual. That's not the way it works in the stock market, typically, unless you want to sell short shares. Most people don't do that though. But when we're trading options, the way that we learn in this system is to open the position. You're going to open at a high level. Again, QQQ is our example. We're going to try to get 50 cents credited to our account off of that first trade. So you want that selling put to be valued high when you open it, when you sell it. Remember, when the volatility is high, that's when we want to sell the options. Why? Because the price is higher. So when you sell with the price higher, you're going to make more money. Now, when we close them out, we want to close them out at the lowest amount possible. 1 cent, 2 cent. That's the area that you want to put that debit on, pay a little bit of money to close out the position. So that's what I mean by buying low, closing low. That way you can maximize your profits and get the positions closed out as early as possible. When I first started doing this, I would leave the position on all the way to expiration. I didn't even want to pay that $1, that $2 to close it out. But as I've learned, as I talked to more people, as I saw some of the drawbacks, as I saw the risk, as I saw the capital efficiency, I learned that you actually want to close it out as early in the trade as possible. Some people close out at a 50% profit. That's the way Tasty Trade does it. Some people close out way before the expiration date. I don't like to do it that way. Again, with this system, we're taking advantage of the theta decay. We're taking advantage of the gamma benefits that really start to accelerate as you get closer to expiration. So we do hold it as long as possible in order to get it down as low as possible. 1 cent, 2 cent debit, close it out. Okay. So the reason that's a good thing, you're taking risk off the table, you're freeing up your buying power, and it's only costing you $1 or $2 max per lot. If you leave the options contracts all the way to expiration, there's always a chance, no matter how remote, that the market can turn against you, that there could be an announcement, that there can be a trade war, that there could be a tariff, that there could be a calamity of some kind. There could be something that is going to turn the market around or turn a specific underlying around. For example, maybe the oil market starts to tank. So either way, there's always something, there's always a chance that you could have a sharp reversal in one of these underlyings. So the position would start to gain value and potentially turn into a loser for you. So we don't want that to happen. We want to close these out. So we always close the options that are in the money. And again, we want to close the options that get to a 2x loss. So why do we close when they move in the money? Well, if one of your positions ever gets in the money, you want to close it immediately. The in the money position is going to move very quickly against you as that underlying goes down. So, you know, you're probably thinking, well, if it's a 2x loss, how is it ever going to get in the money? There are cases, particularly with things like TLT, that are kind of moving slowly downward, especially if you have a $5 wide spread, that if you're at, let's say, 89 with the stock price and you're at 89 with that put that you sold, sometimes you can be only losing 50% or 100% of your original value, but you now, as you move below the strike price, your underlying price is going to be in the money. So we don't want that. We don't want the assignment risk, and we don't want the accelerated losses that come along with that. So we always close these out when they go into the money. So you close them out to avoid assignment risk. So you might be wondering what assignment risk is. Assignment risk is something that occurs when the buyer that you sold that option to exercises their option. That's going to force you as a seller to fulfill the obligation that you put that contract on for. You're going to have to buy 100 shares at the strike price. A lot of people try to play games where they're trying to time it and think, okay, are the shares going to go up? Are they going to go down? They're going to try to leg out of the trade. They're going to try to hold the shares. You know, the way that we teach it is in order to preserve capital efficiency, you don't want to hold on to those 100 shares. You want to get rid of the 100 shares. So you can fight another day. Now, again, so what we do, if the short position gets assigned, I recommend that you exercise your long put or sell the shares and close the long put at the same time. So you want to get out of that position completely. Hopefully that makes sense. That's going to preserve your capital. There's also another scenario that's quite dangerous where the option could move in the money after the market close. So you're probably not familiar with this, but at 4 o'clock on Friday, that is not when the option market closes. It's when the stock market closes, but there is a settlement time for professional options traders that occurs after that 4 o'clock threshold. That's when some really bad things can happen to you if you have a position that's in the money, or if you have a position that could get assigned, which is in the money. So there is a scenario, and there's videos out there in YouTube that talk about this in detail. But if the stock price were to continue to go down in the aftermarket for your underlying, you're going to lose whatever the potential loss value is for that stock loss. And that is out of your control because you didn't close your position, you left it on. Settlement can occur after that 4 o'clock on Friday, and the settlement could make it where you have a loss value that is equal to the stock loss. So if you had, let's say, Tesla that had an earnings announcement after 4 o'clock on a Friday, and they had a terrible earnings and the stock goes way down, you would actually be responsible for, if you had been assigned those shares, you could get 100 shares assigned to you. The stock goes way down. And when you wake up or when you get up Saturday, you look into your account. Now you've got 100 shares of Tesla at a price that has dropped dramatically. So you thought your max loss was $500. Well, it wasn't, because what they did was you lost your put that you bought as a protection. They kept on the sale of the put. You got assigned those 100 shares. Those 100 shares dropped. And now on Saturday morning, you could lose thousands of dollars on Tesla or any underlying that you're doing this in. Do not play with fire. Close out those short options before expiration. That is mandatory in this system. So let's go through a example. Now, what I like to do is when I make the trade, when I put on the trade, open it up, I like to put in a 2 cent close order immediately just to get that confirmation of execution, get the trade out there. It sets a positive expectation and you can set it and forget it until expiration. And then you double check it at expiration to make sure everything on that expiration Friday is closed. Okay, so let's take an example of a DIA trade. So you go in, you look at your positions held. Let's say you just put on a DIA credit spread for 28 days out. You click on it, you go to trade, you click on close, click on the number of contracts that you have available. You click on time in force. So you want to make sure you click on good till canceled. One of the things that Robinhood does is it defaults to good for day. So you don't want that. You want it to be good till canceled. You have to go in and manually hit that every time. It does not allow you to change your trade preference. Okay, so you have 10 contracts, you have one or whatever it is. You go in, you set it for 2 cents. So again, they add in 85 cents of fees. Okay, you get a regulatory fee and then another fee. You go in and you say review. Okay, so it's going to charge you $20, which is 2 times 10 plus the regulatory fee for 85 cents. You make sure everything looks right. So you're going to close out the buy at 445 on 1212. You're going to close out the sell for 440 on 1212. It's going to release your collateral for 5,000 because it's a 10 lot. Typically, you're going to be using a 1 lot, so it would release that $500 of collateral. And then you just swipe up to submit, and the order's queued. So it'll stay on throughout the 28 days, and it'll execute when the DIA credit spread gets down to 2 cents. It's simple as that. And you hit done, you're good to go. Okay, so that's the good news. The bad news is sometimes you're going to have to close out these positions at a loss. This is hard for some people. They want to do everything they can to kind of wiggle out of that loss. They want to leg out. They want to try to extend the duration. They want to, you know, roll them out. They want to acquire the shares. I don't recommend any of that. Keep it simple. It makes it much more capital efficient if you do it this way. I understand some people cannot stomach losses, so it's important to understand your own psychology and be disciplined in your approach. Losses are part of this system. They are welcome, they are expected. We trade at an 85% probability of profit, which is that negative 0.15 delta. So the inverse of that is you should have around 15% losses. About 1 in 6 is around 15%. So if we're trading 12 per week, you should have 2 out of 12 on average that are losses. It's expected, it's accepted. Take the loss and move on. Look at it like you minimized your loss and you're that much closer to your next profitable trade. Many times in times of volatility, we're closing trades and we're opening them on the same day. It's healthy to have losses and it's critical to mentally be able to accept these losses. And eventually in time, you'll understand that losses are part of the system. You trade them, you move on. They're typically clustered in times of high volatility when we move from low volatility to higher volatility. But just set your expectations that you're going to typically have 2 trades a week that you lose. That's mentally going to help you prepare for those losses. Over time, again, the math's going to work out. The percentages are in your favor. You're going to win 85% or more of your trades. We have an efficient stock market. I do believe in the efficient market theory. The Black-Scholes model, it works. It's an efficient options pricing model. You have to have some faith in this system. But I'm telling you, after 4 years of this, 5 years of this, trading, the put path option system, I'm getting around 85% or more of wins. And this year, I'm getting around 91% wins, which is highly unusual. So, you may be wondering what can affect that winning percentage. Many times when volatility is overstated, you're going to actually achieve higher than 85% winning percentage. Sometimes I've seen the winning percentage in bad years go down to like 82%. Earlier on this year, it was up to 92%, but 85 is kind of the expected value. When you close at the 2x loss, you got to keep in mind these positions still have no intrinsic value. We close them out of the money. We close them preemptively to make sure that we don't have extreme losses. That extrinsic value is calculated by the market. It's calculated by the Black-Scholes model. We want to make sure that we are closing in a disciplined fashion. If you did leave all these trades onto expiration, most likely the math is going to tell you that 85% would be your long-term winning percentage. So why don't we just leave them on? Well, because of the risk that I just was mentioning with assignment, because of the risk for aftermarket assignment, and because some of your losses, if you leave them on, times you know, or past the 2x and 3x losses, they're going to get large and they're going to offset your wins. So you got to close out at 2x to cap that loss, preserve your capital, move on to the next winning trade. After it gets over the 2x loss, it starts to lose quicker and quicker and quicker. So if a stock is going down and you breach the 2x threshold, to go from a 2x loss to a 3x loss is quick. To go from a 3x to a 4x is even quicker. So you have to get out of that trade at 2x because as the stock price continues to move down, you're going to continue to accelerate and lose money even quicker. So when you see it at the 2x loss, whether you're in Fidelity, it'll tell you the percent loss. If you're in Robinhood, it tells you the percent loss. So let me show you in Robinhood. So you can see your positions held. So you can see here, I have one that's approaching a 2x loss. It's almost at a 200%. So on Monday morning, I need to monitor that I bid and make sure if it breaches 200% that I'm going to sell it immediately. The rest of these positions that you see on the screen are fairly healthy and they're not even close to a 200% loss. So you're not as worried about them, but you do have to monitor that one at the top. That's a great example. That 172% loss, that is going to be highly impactful. It's highly teetering on the edge. So you got to monitor that. So on Monday, I need to monitor that trade. Hopefully that makes sense. And then with Tasty Trade, it's a similar concept. They show you the percent loss. And again, if it gets over 200, you have to close it out. So who cares if it's a 2x loss, a 2.1x, a 2.2x, a 2.5x? Don't get too caught up about that. Just close it out once it hits the 2x loss. If it takes, a little bit more for you to close it out, that's a good thing. You want to make sure you get out of that trade. So let's take an example. If you collected a 50% premium on a QQQ trade 28 days out and starts to lose and lose and lose and decline and QQQ starts to go down day after day after day, let's say at the end of the third day it has a sharp decline and now the spread is worth 150, $1.50. You need to close it immediately. So that's going to breach your 2x. So what I mean by that, you would lose $100 net on the trade, which is 2 times your original credit of $50. That's why it's called 2x. So again, Tasty Trade, you look under P and L, open percentage, Robinhood, as I just talked you through, you look under total percent change. When it hits the minus 200%, it's time to close. Don't think about it, just do it. Now, I want to also, you know, let you know, sometimes you think the market's going to turn around. Sometimes you want to just put an order in and then wait, come back in 15 minutes, 30 minutes, make sure that it's, you're monitoring it, you're kind of looking at it, hoping that the price will come back to you. You could be losing 250% and you put the loss in for 200%. That's a mistake. Don't wait for the market to come back to you. You want to continue to put trades in continually over and over and over until you get it to execute. Once your position breaches that 200% loss or 2x loss, put in your close order, then chase that market price up. You're going to have to put in debit after debit after debit, increase your price loss until it closes. Don't wait for the market to turn. Don't put it in order and wait and see if it comes back to you. Don't hope. Hope is not a strategy. Walk that price up steadily by placing closing order after closing order until it executes. That's essential. I cannot emphasize that enough. Do not play games with this. You have to avoid those large losses and put in your closing order until it makes the execution. So how did 2x become the sweet spot? I've tried all the way from 1x up to 3x, at varying points, 1.25, 1.5, 1.75, 2, 2.25, 2.5, 2.75, 3. All of those points along that loss curve, there, you know, there's various reasons why you don't want to be on the 1x side. If you start to trade at a 1x loss, you're going to be closing positions too early. And a lot of those positions are going to come back to you. If you wait till the 3x loss, now your financial debits are getting too large and your profitability goes down. So we found that looking at all of these trades, thousands of data points, that 2x is the appropriate amount. Okay, that wraps up the put path. Again, stick to the system. You could get up to 50% annual rate of return. Some years it's less than 50%. Some years it's much more than 50%. 2025, it is much, much more than 50%. I think over time right now, I'm looking at about a 59% annual rate of return when I look back all the way to 2020. So it's fantastic. I've seen it year after year after year after year. So hopefully this has been helpful. Again, this is the video series that accompanies the blog post. I'm going to put together a more formal training for the put path. It's going to be something that you can access in more of a course format. It's going to be a full, put path course that has in-depth training. I'm also going to be offering membership to people that want to join the Put Paradise membership. And that way you're going to be able to get real-time trades. So I just want to encourage you, stay with the Put Paradise website, continue to engage, continue to try, get started, get out there, and make it happen. Happy trading.